let's move on to asset allocation and the take on these markets. Some top picks, stock specific. Marcus Bogdan from Blackmore Capital joins us out of Melbourne. Marcus, pleasure to have you on the program today. I want to kick it off with, I guess, your view on markets first and just what we're seeing at the moment. And I know this is seemingly an ongoing discussion about the rally that we continue to see. How important is it to be quite stock specific in these markets, I guess, to find the value and growth that you're after?
Good morning. Thanks for having me on again. In relation to the market, I mean, for the quarter, the market's up almost 25%. I think having diversification in the portfolio, different drivers of return and risk is important. We are tilted towards defensive growth, and that has certainly been left behind a little bit in the last rally or so. The market PE for 2021 will be around 17 times, but the dividend yield of 4% is still attractive. So we would say absolutely stock-specific ideas, but having a level of diversification in the portfolio is incredibly important at this point in time.
Do you think it's important to be investing in those big name stocks like the CSLs, like the defensive, some of the supermarket names? Maybe we can talk in detail about how you feel about some of these names. We can start with CSL and how they're faring during this COVID recovery.
Sure. Well, CSL has been a laggard in the last quarter, and their recent updates have suggested that demand for their plasma therapies business is incredibly strong. There is a global shortage, but it's the supply side which is affecting that business, particularly in the United States, where they have donors that come to plasma collection centres, and those donors, that volume is down around 20% in recent months. Now, this will have a little impact for this year's financial year, but for next year, it will definitely have an impact. So COVID has affected the supply of their raw materials for CSL. So that's certainly a short-term headwind, but the underlying drivers for the demand for their essential blood products are certainly strong. The other part of the business, which is facing incredibly strong tailwinds, is their influenza business. We've had a record level of doses ordered by the federal government in Australia, and then the forward orders in the United States are also strong. So there's been a pause and a slight pullback in CSL's price. There's still priced for growth in PE of around 40 times. And so we think it's a core portfolio stock. But in the short term, there's certainly headwinds in terms of supply, but we can still see growth of sort of at least 10% per annum over the forecast period.
When you look at CSL and I guess some of the moves lately, we've seen the head of the vaccine business step down. We've seen obviously the CFO, high profile move to BHP. I mean, obviously Paul Perreault has been in the position for a very, very long time as Chief Executive MD. So, I mean, in terms of the helm not changing, I mean, it's not a huge change, but does this cause, I guess, not friction, but I guess some uncertainty in the business at all in your view going forward, just in terms of perhaps a change of tact, a change of strategy? What's your view?
I think it's important to focus on. I mean, the history of CSL is they have managed management change incredibly well. So I think that is certainly a tick for the business. This is an unfortunate parallel of both having the CFO and also the recent head put into the influenza business leave at the same time. But I think the underlying strength of the business, of management and of execution, just looking at the history there, would suggest that CSL can continue to be well positioned as a global leader both in plasma and vaccines. And they really are a leader in terms of technology and efficiency. I think that will continue, but it's certainly worth noting the most recent changes in management.
Well, let's talk stock execution then. We've seen Woolies come out with their numbers yesterday, expecting that full year EBIT to be between 3.2 and 3.25 billion. That was a slight fall off the previous year, but sales continue to go up. How do you see this stock executing and the value there?
Sure. It was a fully packed analyst briefing yesterday with a trading update, an update on significant items, and also a very significant investment in distribution centres. From a trading perspective, sales volume has been incredibly strong, ahead of market expectations. It's been strong in food in Australia and New Zealand. Big W has had a resurgence in sales, like-for-like sales up 27%, and Endeavour Drinks, the bottle shop, and Dan Murphy have also performed incredibly well. But the surge in sales has come at a increased costs with COVID. The costs around implementation of PPE and safety and hygiene have been around 275 million at the upper end of that range. I think those costs will dissipate into the new financial year, but it does highlight the underlying strength of these consumer staple businesses and why I think they remain a cornerstone in portfolios. There was a rise in significant items, restructuring costs with their drinks business, and remediation with their salaries as well was also weighing on that. But net EBIT I think will be down around 2%, but for this financial year. But I think they will start to recover and get that sort of growth into 2021 of around 8% earnings per share. So we still think it's a core stock in the portfolio, strong balance sheet, and an attractive dividend yield as well.
I know you sort of mentioned it there, but how closely are you watching the distribution centres for Woolies and the automation of these distribution centres? Because I imagine this is a big catalyst for them going forward, just in terms of the future of the business, looking very different to how it looks now. Given that, yes, COVID's obviously brought forward the reliance on online groceries and a lot of, that sort of structural change, I guess, we're seeing in grocers. So is this a key catalyst for you when you look at Woolworths going forward, just how they're dealing with that strategy in particular?
It's absolutely pivotal what they are doing around distribution centres and automisation. You've seen Coles move into that direction with a tie-up with Ocado there for their online distribution. But for Woolworths, this will improve their range by around 30%. Their on-shelf availability. It will take 4 years for this to build. It's a very positive step for Qube, who at Moorebank, they are leasing this land to Woolworths. But for the supermarket industry, for them to automate, to become more efficient, to drive their online sales, because online sales are sort of a net neutral earnings, and they need to be able to deliver positive earnings for that type of business going forward, and they can only do that through the investment through technology.
And on the back of Qube's valuation then from this collaboration, the leasing of land, how do you see their value? It's just trading at about $2.90. Morgans has come out with an increase in price target to $3.30 a share. Do you see a lot more upside for this stock?
I think this is a very long-dated stock, given the investment they've had in Moorebank. Undoubtedly, this is a very important sovereign asset for Australia. To get Woolworths to invest significantly, $700 to $800 million into the two distribution centres is absolutely significant, and also highlights the importance of this logistics park, and where you want to be pivoted in property around distribution and logistics, where I think the forward-looking growth for this type of investments is particularly encouraging. So we like Qube. They've recently had a capital raising to strengthen their balance sheet, but the importance of the assets that they own have very, very sort of long duration attributes.
Great to chat, Marcus. As always, some really good insights there on a couple of key stocks. Thanks for joining us on the program.
Pleasure. Thank you.